Welcome to FOMO Investing. I'm Brian.
And I'm Mick.
And we're a podcast focused on investing where we explore the various biases in investment decisions.
And what drives investment outcomes.
The information provided in this podcast is for entertainment purposes only. It is not intended as investment advice, so please do your own research.
Hey, Brian, how's it going?
Mick, great to see you today. What's on your mind?
Burry, Michael Burry. We've been chatting about him offline. I think be a good idea to maybe share some of those thoughts live on the pod. What do you say?
Right. So here at the FOMO Investing Podcast, we cover not only our own ideas, but we like to track what some of the big voices out there are thinking, some of the influential voices, and Michael Burry's certainly been one of our generation. Famously was featured in The Big Short, was shorting the subprime mortgage market. He's run a fund twice. I think he recently shut it down to start a newsletter called Cassandra Unchained. And so now he's out there with more opinions and more voices. And I signed up for his newsletter to get a sense of his ideas and thinking. What do you know about this, Mick?
It's a great resource. It's interesting, right? So pre-newsletter, you could see what he was investing in his 13 Fs. And that gave you part of the picture, right? So when he bought a long position or he bought puts, you could see all of that. But you really didn't get his unfiltered thoughts. And I think Cassandra Unchained, it'll be interesting to know if it's a better financial deal for him or not. But certainly for me, I probably, I didn't know him personally, so there's no way I could invest in his fund. But here I can follow his kind of unfiltered thought process through the newsletter, and then also the Substack format with the Q&A. It's really interesting as he shares some of his thinking behind his posts. To observe and, to help develop your own investing style. I found it quite
right. And so what I appreciate this is he is opinionated, but he's very detailed in his research. So he takes a very forensic accounting approach to his analysis to come up with reasons why there are structural flaws, there's considerations in some of his ideas that could be very fragile. And he's also often, I would argue, mostly a contrarian. He is bullish on a few ideas, but he does look for things that are, and that goes back to his Big Short fame, where there could be some errors with the consensus thinking in terms of what the idea is and how it could play out and what could go right and what could go wrong. And it helps create that balance in the market, right? That you have that voice. He's also very long-term in his thinking. So I think
super long-term. Yeah.
People like to prove his ideas wrong in real time, but I don't think that's where he's thinking. He's thinking, structurally in the long run, this is not going to play out correctly.
No, he's playing a really long game. That's undoubtedly true. Whether you think of him now or you think of him back in his Big Short days. What's kind of interesting is, preparing for this and, reading through some of his history, he's a little bit of an accidental short investor. He started out as a long only guy. And it was his, deep research into the subprime market that, thinking about it from first principles, that gave him this unique window into like, hey, this stuff is trading at premium, but it's really collateralized obligations that aren't going to pay off, and what he calls a once in a lifetime trade. I think that kind of switched his investment style to maybe a bit more pessimistic short seller approach that he's now kind of known for.
Well, he's an interesting observer of changes that happen within these markets, because whenever there's obviously profit to be made in any industry, you're going to have people who push that to the limit. And so I'd like to draw some of the conclusions from, sort of his thinking and sort of what happened to the subprime market where, we went to no documentation loans and we had interest only loans, where it really pushed the market. And then of course the CDOs, synthetic CDOs, and these new ways of just pushing the envelope and why that caused vulnerability. And is that happening today in some of the markets that he's describing? So there's a couple of ideas out there. One is stock-based compensation. The other, I think, is, some of the depreciation and useful life in some of the AI chips. So where do you want to start there, Mick?
I think we should maybe focus on his two big calls that he's made. And, I think even before he started Cassandra Unchained, there was a bit of a brouhaha about his Nvidia puts and his Palantir puts, right? There was, maybe we should give our listeners a bit of background of what happened in 2025, some of how the mainstream media misunderstood the 13F filing.
Yeah, get right into it.
So, and I think we can link the 13F filing in our show notes. It's super interesting, right? So when you buy a put, you're paying the premium, right? And so what's listed on the 13F is the notional value of the trade, which is multiplied times the stock price. So on CNBC, they quoted, Burry as having a $900 million exposure short on Palantir. And actually the premium, he was buying out of the money puts. So he was buying puts and, Palantir was trading at $200 and he was buying puts at 100.
At 50. And then he thought, maybe it's worth 30 or less. And correct. So that's a bit of a nuance with the data that's transmitted over in the 13F filing. But yeah, it seems to be that, it is a misstatement, but it's still directionally correct that he thinks that the stock is and these are way out, right? These are 2 years out. So that it will be worth less, but just dig into Palantir and some of the thesis there in terms of why he thinks that. So, regardless of the amount of his position and how he's positioning to trade against the stock, I think he's got some interesting points there. Yeah.
So there's a lot to unpack there. If I were to distill it down, I think his take on Palantir is, there's some claims of almost direct fraud, and then some claims of misrepresentation, sort of gray area, right? I think sort of the biggest claim is, so what is Palantir? What is the business? His claim is it's more like a consulting company. It's more like an Accenture or an IBM in some ways than a pure software company that does R&D, has deep research in developing their own product, right? So, disclaimer: I've never used Palantir technology, but I'm deeply interested in the tech space. And so my sense of it is Palantir is basically this sort of layer on top of your data sources. So, if you're a business or you're a government entity, you've got a ton of data sources, right? You've got your HR system, you've got your CRM system, you've got all of these systems that don't talk to each other. And my understanding is Palantir is this sort of layer that brings these data sources together and brings some machine learning type techniques so you can cross-pollinate and ask questions across these systems.
Well, it's exactly what it is. So it kind of grew out of the siloed natures of the intelligence networks where there was, various groups, the Defense Intelligence Agency, the CIA, and others that were doing similar things but weren't sharing data. And so to stitch together some national threats data and then how that applies more broadly across governments. And his point is that machine learning has now just been rebranded AI, right? And so, they were in the right place at the right time to help with that problem and develop software for it. But whether or not the businesses deserving of software margins or more of a consulting based business over the long term. And then when you consider the fact that, the stock-based compensation has basically negated all profit from the business. So like whether or not the valuation makes any sense. I mean, he's not trying to say that, and this is very different than sort of the next conversation we'll have around Nvidia. He's not really questioning whether or not, the valuation of the product. It's really about like the value that can be derived from the product, like the LLM, because that's we're sort of emerging. It's really about what is the business like in Palantir's case.
What is the business? Is it a software company or is it a consulting company? His claim is it's more like a consulting company, and he has some, I mean, I don't want to divulge too much of what some of his proprietary stuff in Cassandra Unchained is, but he has some pretty compelling forensic accounting takes on Palantir in particular. I think one which he was recently on the Michael Lewis podcast, where he has this heuristic of the number of billionaires to sales ratio, or the BS ratio.
I love that. That should be taught in business school. So tell us what the BS ratio is.
So there is less than $5 billion of sales in 2025 from Palantir, something like 4.4, I think, was their sales. And there's more than 5 billionaires. So the number of billionaires to the billions of dollars in sale in Michael Lewis's articulation is unprecedented in any other company. So it's really a valuation call that this valuation relative to revenue, and obviously revenue is the top line number, then you've got to get to operating, gross profit and operating profit. And he has some fairly strong claims in terms of their questioning their presentation of data and accounting data and GAAP data. But
it's a great point. Just to give some context here in terms of what we're talking about, we've got a trailing 12 months revenue is about $4.5 billion, right? So, but the market value we're talking about is, north of 300 billion. So the enterprise value is 310 billion. So we're talking a huge revenue multiple here for a company that doesn't do a lot in terms of profit. Arguably, their messaging is around the cycle right now is to continue to invest in growth. But yeah, it is considered to sort of be defying gravity. And some of these companies can continue to do that for quite some time. So whether or not the end is imminent or if it's, they've got several more years of growth ahead of them, I think that's what we're trying to reconcile as investors. But, it's going to be a story that will continue to play out, whether or not the appetite there. The interesting point that he did make recently, which I'd love to hear your thoughts, and this is maybe a segue into our next conversation, Mick, is that companies like Anthropic are eating Palantir's lunch.
Yep.
Because the enterprises used to be about 50% or roughly 50% government. Now it's gone to be majority into the commercial sector. They're looking at how they deploy AI technologies and tools across their enterprise, and every board of directors wants to know, what are you doing? The appetite seems to be more and more for these AI companies like Anthropic. And maybe that's going to be edging out Palantir in terms of their opportunities. What do you think about that?
Yeah, it's interesting. I think he actually makes the claim that, after ChatGPT at the C-level, there was some amount of FOMO around AI. And essentially that the C-level suite were pushing CTOs, hey, you need to get into this AI thing. And Palantir was a great way to get in because they've been doing machine learning and they rebranded that as AI pretty quickly, right? And so the growth you're seeing is adopting this sort of kind of aggregation layer and retrieval augmented generation AI, the AI curve now that you're seeing at the foundational models at OpenAI and Anthropic, where Anthropic has gone from a $9 billion run rate in December 2025 to a claimed $30 billion run rate somewhere in March, April 2026.
That's an incredible number. I mean, we should just pause for a second. So they were giving guidance of 9 billion at the end of December, and 1 quarter later, they're guiding to 30 billion. I mean, that's an incredible amount of growth. And so, and this is, I think, the second part of our conversation, Mick, is it's about whether or not AI is a bubble. And, core to understanding that there's two sides of the coin here. So, I mean, two ends of the spectrum. One is whether or not there's this issue around the useful life of chips, and whether, because the Nvidia has shortened, for example, its cycle time from 2 years down to 1 year, and that these older chips are not being depreciated correctly because the useful life is shrinking. And the second part of this, and we should break this up, is whether or not the value is being achieved from customers who are buying these chips, whether or not you're gaining revenue and achieving growth. And I think they're very different issues that support that are part of this AI thesis, and whether or not we are in a bubble. Let's go into the depreciation issue first, Mick. What are your thoughts there?
Yeah. So to frame it, I think Burry's claim here, he's short, he's not short. He's got puts on Nvidia, similar to Palantir, right? Burry's claim here is that the depreciation schedule that the companies buying the Nvidia chips, right? The Googles, the Metas, the AWS, all of these companies who are spending now hundreds of billions of dollars on capex, large part of which is fed to ultimately to Nvidia. They've extended their schedule. So they started originally their depreciation schedule was 4 years, and they've slowly drifted to 5 years, 6 years, right? So what is the economic useful life of these chips? So you buy a chip, you put it in your rack, it starts producing dollars. If you're a Google and you're on Google Cloud, you're renting it out to customers, it's producing revenue. How long does that produce revenue? Does it produce revenue for 4 years, or does it produce revenue for 6 years? And how much, right? So maybe you're able to sell it for, make up a number for $100 initially. Does that depreciate over time, right? With the newer version of the new Nvidia chip, do you now need to discount that from $100 to $50, right? Over time.
And what is the accounting implications of extending the depreciation useful life?
It lowers the annual depreciation cost that hits your P&L,
which makes profits look better.
Makes profits higher. And so Burry's claim is maybe the real depreciation schedule, given the pace of innovation that you have here, right? Given the pace of innovation that NVIDIA is changing fundamentally, they've changed, as they've gone from Blackwell to Vera to Rubin and all these different generations, the capabilities that maybe the depreciation schedule is less than 4 years, which is a fundamentally different economic profit than what they're showing on their GAAP earnings.
Right.
The Metas, the Googles, and the Amazons, if you will.
Well, it's an interesting thesis, and the response by the companies have been, well, actually, we do know that we're still getting useful life from these older chips, right?
Yeah, I think Mark Andreessen was recently on another podcast, on the Latin Space podcast, making fun of Burry, saying, hey, you got it absolutely wrong that these guys, that his word, the word on the street is Google is actually renting out 6-year-old, 6-year-old Nvidia chips that are off their books. And they're actually renting them out to customers at prices that were higher than they originally were able to command when they first acquired the chip.
Right. And well, that's a function of not only the demand for AI compute, but it's also a function of the fact that you can use it for different types of workloads, that not every workload needs to be a state-of-the-art chip, that you can use different things for different purposes. I actually think it's a great self-awareness thing for companies to now say, let's go figure out, are we getting the useful life for all of our various chips, and understand where that is? Because I think from an accounting perspective, they kind of just put out round numbers in terms of like what they're depreciating at. And we all know that, like, if you had the resources, and I've worked inside companies in accounting and finance before, public companies where we would do this, it's kind of a shortcut. But now with AI, I feel like you could come up with the exact number of useful life and then have a replacement schedule that manages that better. So like, there's no reason why Microsoft and Amazon and they couldn't put out the exact useful life number.
Sure, but I think part of this, part of Burry's claim here is kind of forward looking, right? We are sitting here in April 2026 in a market that is still supply constrained on the chip side, right? So of course, any chip that's out there is going to get used. But at some point, valuation is a forward-looking game, right? And I think his theory of the case is that at some point we're not going to be supply constrained. And like, he draws the parallel between Nvidia and Cisco in the late 90s, in the dot-com bubble, that, you could have compelling. I don't think, like in Palantir's case, he questions whether the technology is really technology and they're a consulting company. With Nvidia, I don't think he questions the technology. This is amazing technology, but is the economic moat that investors are drawing around Nvidia correct, not just in today's environment, but in tomorrow's environment? I think that's the claim.
Well, and I think what he's missing is that AI is not just large language models. I think he's looking at he's questioning the value that you could get just from large language models in terms of the AI use case. But you and I have talked about this on prior pods, which is that the AI use case is going to be so many other things, right? From physics AI to other things that are involving, that beyond sort of the spoken language, that there's going to be things that are going to be fed into large language models that will, not just large language models, but to AI tools that will derive additional value that could be even bigger markets than large language models.
Yeah, I think it's worth stopping and reflecting on that Anthropic number of a 9 billion run rate to $30 billion. A lot of that is the coding thing, right? That's really what that is Claude Code came out, and I'm pretty AI pilled, and if you read between the lines on Burry's thing, he sounds kind of AI pilled too. It looks like he's using coding agents in some of his research and some of that stuff too. It fundamentally, whether you're an equity research analyst or a developer, AI is going to change your workflow. I'm pretty convinced of that, and I think you would agree with that, right?
I would, but he does make an interesting point, which is, when he was doing his stock-based compensation analysis in Gemini, that it was coming up with the wrong answer. So you have to still take that approach to deconstruct some of the questions better in terms of what you get from AI, so that it doesn't hallucinate, or still have that bottom-up approach to being an equity analyst, which is to say, let's feed in the source documents, let's iterate on those, to get you the answer so that the AI is understanding.
Yeah, I mean, my opinion on that is that's just user error, right? Like you don't ask an LLM what is source data, right? You ask an LLM to go get source data for you, so you don't have a hallucination. And it's a new tool. We're all learning to use it as we go, and so I think hallucinations. Absolutely huge problem. Equity research, developer, lawyer, wherever you're trying to use AI, you need to be, this kind of old news. You need to be careful of hallucinations, but we need to also know how to use the tool to avoid hallucinations, right?
Right. Well, and his point is a really good one, which is that that it is still about asking good questions. And, we're active investors, and he's an active investor. And so much of the market has moved to this passive or algorithmic based trading. It's not the amount of participants in the market like you and me and Michael Burry and others that are really trying to understand what is wrong with the current view or where there's opportunity because things are not being well understood. And I do get frustrated with this sometimes when you look at the dumbing down of investment research and you get like I won't name the names, but there's various of these sort of these pseudo analyst companies that are just putting out a star rating or a something like this. And it's not based on a whole lot of information other than the fact that maybe it doesn't look like a traditional value, easy to understand company. And when you have complexity in some of these ideas, and no company is perfectly simple, but some are very complex. And when you have these complex issues and you have these transitions in companies from being sort of early stage to really, are they going to be do they have a 20-year runway ahead of them? Do they have a 5-year runway ahead of them? And you're trying to figure that out. That's what a smart analyst can do by asking a lot of great questions into the fundamentals of the business. And we've seen that even with like the software stocks, like, they've gone through this great cycle now where, we thought these subscription software businesses were the thing because they had so much visibility and maybe they don't. And so I think there's still some, I'm not saying they're going to disrupt all these companies. AI will still not be able to do some of the things that are being done by some of these very entrenched.
Oh yeah, we could do a whole pod on kind of the software dumpster fire and what's really of value, what's really not, and absolutely. I guess my broader point, linking back to Burry's Nvidia puts, is maybe this time is different with AI. I don't know. Is it inevitable that we will be in a bubble and then, the TPUs, the Trainium chips, all of the chips that these other players are trying to do to catch up with Nvidia will ultimately solve the supply problem? Maybe Burry's correct, and then Nvidia's valuation craters.
Well, so the point here is that they certainly have a market lead, and other competition will come into the play here. So the customers of them are all developing chips, the large ones for sure, and whether or not those will catch up and be useful, or there are certainly other chip companies out there, AMD and others, that are doing AI chips. We're still in this period right now where you don't know what inning you're in until like we're sort of near the end, right? So we didn't really know in the internet build out where we were, what inning we were in, and so everyone's out there with an opinion, and they kind of say we're here, we're there. It's hard to know because the revenue is still growing so quickly that to say that he does this calculation, which is GDP with a comparison to capex.
GDP to capex, yeah, and that we're at like, by that metric we're kind of like near 1999, 2000, or
right.
Maybe even
do
higher
you see these
that.
periods of bubbles? But the question I have, and this is not we'll never know until, well, 20 years from now, we might know. Is this just a new step up? Are we now at a new plateau of this is what spending could look like? And that these companies that used to have these very light business models now have these very capital intensive business models, which is going to require continuing investments in very advanced technologies and chips and data center build outs and things like that, which is just a new normal, right? It's going to be a new normal for.
And are they going to get a return on that? That's another contention that he has, right? Like the Google that we know and love is based on marginal costs that are close to zero. AI Google doesn't have zero marginal costs anymore.
Right. That's a really good point. Well, it's a story we'll continue to follow.
Yeah. No, absolutely. I'm super glad that Burry started his newsletter, and we should absolutely continue to follow it and share.
What I like about this story, Mick, is that it actually, because he's a respected voice, people are listening to him this time. You know, I feel like the first time around he was a kind of a lone wolf and was out there with some opinions and you know, his own investors, except for I think one guy, they were against him. It sounds awful, but like, you know, he stuck with it and closed redemptions from his fund in the mortgage crisis period. But now I feel like this brings a certain level of self-awareness to the market that people are going to look at it. Maybe CNBC will get it right in terms of his positions. But the companies themselves can avoid some of the mistakes with how you respond to exuberance in terms of like pushing the envelope in terms of the accounting, inventing, you know, ways of looking at the business that just don't have economic sense. You know, going back to the dot-com boom, and we're talking about eyeballs and we're talking about these non-traditional metrics. If we do stay focused on what the numbers say, and it could avoid the catastrophe that he sees. He still sees that markets, you know, over the next decade or it could be a diminished returns in the stock market in general, just based on his opinion. But I don't know that we're set up for the crisis that you know, a big correction. There will of course be corrections in the market. There always are, but whether or not, you know, there is a trigger from the AI side on what, you know, the spending that's being built out. What are your thoughts on that?
Well, I mean, he might be right. He might, you know, just the timing, right? It might be 3 years from now. It might be 6 months from now. I think he's a voice worth listening to, right? He's a Cassandra. You know, the boy who cries wolf. You know, in the story of the boy who cries wolf, the wolf ultimately comes. So, you know, listen to the boy who cries wolf, and then listen to, you know, you can read his newsletter. You can read Nvidia's response to some of his claims. You can read Alex Karp, or you can watch Alex Karp yell at him at Burry.
It's amazing that the CEO of $300 billion company feels the need to respond like it's a shouting match, and it's going to affect, you know, his success. I think I like the fact that he is thinking long term. So much thinking is so reactionary to today's headlines and trying to say, well, what this happened, now oil prices are going to respond this way, or whatever. It provides a great balance to the market, and you know, we'll have to see, is the clock right 2 times a day, or is he just kind of putting out a overall warning to the market? I do believe he has skin in the game. He said he reestablished his positions after he closed his fund. So
yeah, no, he's definitely, he discloses some of the puts that he's got in his newsletter. There was a really interesting question, because the newsletter now has Q&A. And there was actually a question by a young investor. I think the kid's like 15 years old. And he's like, Dr. Burry, how are you so sure of these put positions that are 2 years from now? And I loved Burry's response. He's like, I usually roll my puts 2.5 months before expiration. So, you know, you might read the put position as it's a specific call on time, but this is a long game guy, right? Like he's not just buying his puts for 2 years from now. He's taking a long call, and he will roll those puts into to longer dated puts.
Yeah, he's also out there tweeting that, you know, he can change his mind at any time. So if he wants, you know, a put position isn't forever. It's you know, he could get the volatility he's looking for in the market in terms of what the market thinks about the AI play or the Palantir business model understanding, and you know, and maybe he gets the spike that he's looking for.
Yeah,
so
he's already made money on his Palantir call, no doubt.
Yeah, it was down, I think, 18% in the last few months. So he's seems to be on the right side. Well, this has been a fun conversation, Mick. Love to follow the story. I love contrarians in general. I love people that are truth tellers, and maybe he'll even do a podcast with us someday. I don't think he does a lot of public speaking, but now he's not regulated. He should be on our pod.
You want to come on, Burry? Anytime.
All right, Mick, this was fun.
But as always, take care, Brian.